Welcome to the Aaron Katzman Show. I'm your host, Aaron Katzman. We speak about your life, your money, and your investments. And as always, we're coming to you from the spiritual and soon-to-be financial capital of the world, Jerusalem, Israel. If you like this content, please hit the like button below. If you've not yet done so, please subscribe to both the YouTube channel and to our podcast. And if you think somebody might actually find this of interest, go ahead and hit the share button. I was going to click the share button. Hit the share button below and feel free to share it with them. They might find it interesting. I'd like to speak today about memory. What was it? What was it I was just going to say? What was that? What did I want to talk about? You get it? Memory? So there's some really interesting research about memory playing tricks on you and investing. So a couple of weeks ago, I had a long discussion with a longtime client. We were discussing how her portfolio had performed over the years. She was telling me that she had sold most of her holdings before the subprime banking crisis in 2008 because she anticipated the market was going to get crushed and that she made a lot of money when she bought back into the market. But I'll tell you something, it seemed to, as often, I'm sort of a skeptic by nature. And once again, I was a little bit skeptical. I didn't exactly believe what she said was true, but I was kind, as I want to be. People don't necessarily believe that, but I am sometimes sort of nice, especially to clients. I try to be at least. I didn't challenge her until we hung up. And then I did a little bit of research. I went back into my system, and I found some statements back then. And it turns out that almost... it was like 180 degrees from what she had said. It turns out that she panicked. And once the market had dropped already like 20%, then she called up and said, I'm done. No mas, right? She threw up her hands, she said, sell out. Okay. And it took a couple of years before she was able to get the gumption back up, the courage to reinvest. So she sat on the sidelines for a couple of years. You can only imagine what ended up happening. And the fact is, I get calls like this when I review, old-time clients and their portfolios. These kinds of discussions happen more frequently than one might think. Dan Pilat, co-founder and managing director at the Decision Lab, discusses how we can look back at an unpredictable event and think it was easily predictable. He writes, the hindsight bias describes our tendency to look back at an event that we could not predict at the time and think that the outcome was easily predictable. Sound familiar? It's also called the knew it all along effect. Now, I never really gave any thought to how that can impact investing until I recently came across a research paper that dealt with memory bias in investing. I thought it was fascinating, and I don't know where I found it, just sort of popped up. Things sort of pop up these days. You ever notice that? The paper was titled, Why Investors' Memories May Be Bad for Their Wealth. Interesting, right? Daniel Walters of INSEAD and Phil Fernbach of the University of Colorado discussed how selective memories of past performance actually cause current investing overconfidence. They write, while much has been written about the dangers of such overconfidence when it comes to the financial markets, there's been less time spent discussing why it is such a common characteristic among investors. This anomaly seems especially strange when you consider how easy it is to double-check past success with a quick scan of your financial statements. The truth, as revealed by new research, is that it could actually be down to the positive bias that investors apply to their memories of past performance. This positive spin can take two forms. Distortion, the fact that someone remembers the size of their returns or losses better than they really were, and selective forgetting, a tendency for investors to fail to remember their losses altogether. I think a lot of us in many aspects of life have selective forgetting, like taking out the garbage. They continue. We came to the conclusion following a series of studies where we asked investors how well they could recall their past deals. We first asked them to share their memories on their biggest wins and losses over a certain period of time without reference to any physical records. We then gauged how confident an investor was through a series of questions that covered their belief in their ability to beat the market and the frequency of their trading. The final step was to ask them to compare their memories of trading success against the actual outcomes of those trades. Well, what did they discover, you may ask? They discovered that overconfident investors, meaning those more likely, ended up being those more likely to trade more often and who had the greatest self-belief in their investment skills, were actually the individuals with the largest memory bias. Go figure. In other words, they remembered their wins as bigger than reality and had a greater tendency to forget their losses, both of which helped them uphold and perpetuate their confident opinion of their ability as an investor. Fascinating, right? They remembered things incorrectly, right? They were better than they actually were, and they didn't remember their mistakes, their big losses. I just think this is so interesting. We can learn from this is that investors should actually sit and review their past statements to actually see how they're doing. Be honest with yourself. Are you actually doing a good job, or are you kidding yourself? It might not be so fun to see in black and white what you have that you actually haven't done so well. But that honesty can actually help you grow your wealth over the long term, right? We have tools. You don't have to keep guessing. You can just sit down, analyze over the course of a year, 2 years, 3 years, 5 years, how you've actually done. It's pretty easy. It's all going to be in black and white. We recently read, we read in The Ethics of the Fathers, 428, chapter 428. Rabbi Elazar HaKapar would say, jealousy, lust, and desire for honor remove a person from the world. The Tiferet Yisrael defines the various terms and comments jealousy, out of jealousy to have as much or more than his fellow. He lusts to amass money, even if it entails danger to life. Lust, physical lust, which causes him sometimes squander his money or dignity. Honor, this refers to arrogance. Also due to this, he will squander all that he has and endanger himself. Think about that. As I have written multiple times, humility is a major key to be a successful investor. Only a very few number of investors can correctly predict the future, continually time the market successfully, and doing it time after time becomes virtually impossible. The key to grow wealth over the long term is to buy good quality assets and hold them. Doesn't matter if that's property, right? Index funds, exchange traded funds, even high quality stocks. Virtually all the data points to this. Over the long term, if you want to build wealth, check your ego at the door. Trust the process. Have I ever said that before? Trust the process and realize you aren't going to outperform the market. So why bother trying? Okay? Don't be overconfident. Just forget about it, right? We all, it's like fishing, right? We tell stories, right? Oh my God, I caught a 30-pounder. Okay, but I didn't. 30-pound king salmon. No, can't. Like 17 pounds, 16 and a half pounds, the biggest one, right? But we tend to say things that are a little bit better maybe than they actually were. Do we ever talk about all the times we went fishing, we didn't catch anything? Same thing with investing, okay? Do yourself a favor. Don't try and be so smart. Have humility and forget about what you're actually remembering, because chances are it's not so true. You've been tuning in to the Aaron Katzman Show. We speak to you about your life, your money, and your investments. If you like this content, please hit the like button below. If you've not yet done so, please subscribe to both the YouTube channel and to the podcast. Thanks so much for tuning in. We'll speak to you soon.